Hey guys, so when you talk about the accounting equation, and that's what this is going to be about, is the accounting equation. I'm going to make this quick. I'm not trying to make it pretty. Let me just get this thing a little smaller. We'll stick with blue. I like blue. Okay, so the basic accounting equation, first of all, there are 5 elements to financial statements, right? So basic elements, you have revenues, you have expenses, you have assets, you have liabilities, and you have equity, right? So 1, 2, 3, 4, 5. I counted them right. Well, the accounting equation, this guy, is coming from the balance sheet. The balance sheet is this portion here. And it basically says that assets equal liabilities plus equity. Very simple, right? And I guess the thing behind this is that assets, think about a company, right? You have maybe you have like a coffee shop. It looks like this, and you go in the door, and inside there's like behind the counter there's like a little barista, a little dude sitting there, blah blah blah. He's got his little coffee machine. He's got little cups of coffee, and they're steaming, and we want to buy them. I want a coffee so bad right now. And all these little people come in, right? They come running in. Because they want to come through the store and get a cup of coffee. And when that money comes in, that is a form of revenues, right? But all the money we had to pay to get to that, to getting those revenues, are expenses. Take all those away, we get our net income. Before any of that can happen, though, we have to buy or lease this building, right? So if we buy this building, if we buy the coffee machine, we buy the coffee cups, and we buy the coffee grinds and things like that. All that stuff, those are assets, right? Those are assets. Even the cash in the drawer, those are things that we use operationally to build this business. And they can be short-term, which we call current assets, and I abbreviate CA, or they can be long-term, which we call long-term assets, or sometimes you'll see them called fixed assets. Okay? Now, the other side of that equation is, well, how do we finance it, right? Where does that money come from? So let's draw this section in green. It comes from 2 places, all right? It either comes from you and me, if we start up a company together, and that's where we put our equity in. That is our money, okay? Now, it is our money, but it's also our money, so what we would call our paid in capital, PIC, paid in capital, ... But it's also our retained earnings. Now, retained earnings is nothing more than your net income, this guy over here, right, minus any dividends that we pay to shareholders, that we pay to these guys. And what's left over is called retained earnings, and that increases the value of the firm in terms of equity. And the second one we have is debt, right? We can call it debt, we can call it liabilities, but the bottom line is this is where we go to external people like a bank and we say, I need to borrow some money, right? And again, just like assets, this can be short-term, current liabilities, or it can be long-term, which is called long-term debt. Now, one side note point that's worth pointing out is that our current assets and current liabilities, these are things that are current assets that we can turn into cash, right? These are that we can turn them into cash within 1 year, and current liabilities are things that we have to pay within 1 year, right? So those create our current, what's called our working capital accounts. All right, we'll talk about that later. But back, I really want to finish this in a couple of seconds. So we have Long-term debt, greater than a year. Short-term debt, less than a year. That's where we're borrowing money from other people. And then we have the money that we put into the company that creates our assets, and that creates our equity. We add those together, and basically the money that we put into the company has to be the same as the amount of stuff that we are owning in the company, right? So we own things, and we have to finance how we get them. And really quickly, that means that our assets equals liabilities plus equity. And you can extend that to say that our assets equals current liabilities plus long-term debt plus equity. And you could extend that to say your current assets plus long-term assets equals current liabilities plus long-term debt. That's a plus sign, by the way. It's just not working with me. Plus equity. And we can extend it even further, or we can go back and simplify this and just keep it at assets equals liabilities plus, and here we can say our original capital, so our capital contributions. This is we'll say our beginning equity. And by the way, I think I misspoke calling it paid-in capital earlier, so scratch that from the record. So beginning equity plus our retained earnings. And another way you can say that is assets equals liabilities plus, damn you, liabilities plus, we'll call it B, beginning equity plus, then we put in parentheses, we'll call it, we just so we understand how this is working, our net income minus dividends, right? And that's just a really elaborate way of going back up here to the original thing to say that we bought some things, right? This is, we bought some things, our assets, door handle, kitchen counter, a little dude behind the counter. And then we had to borrow. We either had to bring in our own capital, right, ours, or we had to borrow some money, theirs. Either way, we had to get some cash to buy this thing. Okay, lots of sloppiness here, but hopefully that works out for you. Hope you enjoy it. Bye.